Here's a quick look at the U.S. futures. Again, U.S. data has just been released. It is now all of 2 minutes old. This is gross domestic product figures. And as we've told you, the annualized pace of gross domestic product in the fourth quarter has come in at 2.9%. That is a higher number than the 2.6% expected by economists. Those economists were polled by Bloomberg News. It is a retreat, however, from the 3.2% figure of the third quarter. Well, let's bring in Veronica Clark. She's an economist at Citi and regularly helps us untangle and explain numbers like this. Veronica, what's your early read on this number?
Yeah, I mean, the overall number is a bit stronger than we were expecting, a bit stronger than consensus too. But I wouldn't say it's too far off from really what we were expecting to see in Q4. And confirming that the second half of 2022 was stronger than certainly the first half, and I think a bit stronger than we were expecting initially.
Consumption was weaker than expected with growth of 2.1%. This was expected to be a quarter in which consumption drove growth. Unpack that for us.
Yeah, it's about as strong of a pace of consumption that we saw in Q3. I was expecting that we would see a bit stronger. I would really want to dig into some of the details here. We know that goods spending, for instance, has been, soft for a number of quarters now, and services has really been what's driving that. And I would want to see what happens with business investment also. But yeah, maybe you're getting some more boost from things like, trade or inventories. Maybe domestic demand's a bit softer, but I'd say this is overall still pretty solid reading.
There's nothing here that would indicate the U.S. is approaching a recession. Would you agree on that?
At least from what I see on the surface. Again, I would want to see some of these details. But yeah, I'd say this is a still pretty solid story for underlying activity, especially considering that, you should still have a drag from, the housing sector, which has been soft for a while. We know goods, demand has been falling, and to still be growing at a pace like this, I think it's still pretty solid.
How might these figures look to the U.S. Fed? That's always the key question that investors want when critical U.S. data is released.
Yeah, I mean, if anything, over the last couple months, I think it's been the case everywhere that growth, and activity have looked a bit stronger. And in terms of, the focus for the Fed of getting inflation down, that makes their job a bit harder if demand isn't softening quite as much as they, had hoped. And if anything, we did get some inflation data with this report today. The overall GDP deflator looks like it was a bit stronger than expected. So there is still a lot of price pressures here too. Here
are some of the price index changes that you referred to in the fourth quarter. Personal consumption up 3.2%. Consumption of goods down by 1.5%. Consumption of durable goods down by 3.1%. Consumption of services up by 5.6%. And I think that's in line with what you were expecting, an economy which continues to feature strong spending on services.
Right. That is exactly what we've seen in a lot of the data recently. And that's, for the Fed at least, that is somewhat of a concern because we know that goods demand has softened. We know that supply chain issues are starting to correct, and that's bringing down goods prices. But if you still get such strong demand for services, amidst really tight labor markets, we also got, initial claims data this morning that are very low, then that means there's more pressure on services prices still.
You were asking about business investment as well. Let me see if these figures are what you're looking for. Gross private investment up 3.7% in the first quarter. Fixed investment up 4.5%. Investment on structures up 6.7%.
That sounds like a really strong increase, just on the surface, especially given that residential investment would probably be included in that. We know that residential investment, housing related activity should be still soft in Q4, maybe starting to stabilize a bit now, but that seems like a really strong investment figure given that.
And we'll just remind viewers that gross domestic product numbers in the U.S. have come in with a fourth quarter annualized gross domestic growth, a pace of growth in the U.S. economy of 2.9%. Personal consumption rises by 2.1%. That's weaker than expected. 2.9% was expected. So the headline gross domestic product number stronger than expected. Personal consumption weaker than expected. And the GDP price index, and we were just referring to price index numbers, the headline headline price index number comes in at 3.5%. So let's return to the recession question, Veronica. A lot of people experts are calling for the U.S. economy to move into recession this year because of the abrupt and substantial history of rate increases by the U.S. Fed. What is your view on that topic?
Yeah, we still have a similar baseline for this year. We are expecting a mild recession, but not until really, the second half of 2023, and not really seeing the obvious signs of that, the job loss really until maybe mid-year. So as we're getting into, just the first part of 2023, things still look very strong. Would still expect, some slowing, but maybe if anything, it's a bit later than we're expecting.
And we also this morning have initial jobless claims numbers. Those numbers are released each week, and the number there shows fewer initial claims for jobless benefits than economists had expected. Not a huge gap, but 186,000 new filings for jobless benefits were filed last week. That is fewer than the 205,000 that were expected. And so once again, the U.S. labor market continues to show strength. Would you agree?
Yeah, absolutely. These jobless claims numbers are very low, which is maybe a bit surprising given that anecdotally, we're hearing a lot about layoffs, but you're really not seeing it in some of this hard data yet. That really just does keep pressure on wages and keeps pressure on prices.